Welcome back. You're watching Power Breakfast on CNBC-TV18. Now getting you some policy updates. The Reserve Bank of India has tightened the default loss guarantee rule. Sources tell CNBC-TV18 that the RBI has instructed NBFCs to exclude default loss guarantees from fintech firms when provisioning for stressed loans. Ritu is here with more details. Ritu?
Well, that's right. Our sources indicate that the Reserve Bank of India wrote to select NBFCs in March, directing them to exclude default loss guarantees provided by fintechs when making loan loss provisions. Simply put, the DLG or the default loss guarantee is a kind of safety net in digital lending where if a borrower does not repay the loan, the fintech or the digital lender promises to cover a part of the loss, which as per RBI rules is capped at 5%. Now, earlier, some NBFCs would simply exclude this 5% DLG amount, which theoretically is available as liquid cash from their loan loss provisioning, but now RBI has prohibited that. And now these lenders worry that this will make DLG model less attractive and more immediately also cause them to incur a hit in order to make this additional provisioning on their loans. Now, our sources indicate that the industry, including NBFCs, fintechs, through their SROs like FACE, have been in talks with RBI over this issue over the last couple of months. Now, while the directive first came from the Department of Supervision following their audits, the matter has now been taken up at RBI's Department of Regulation by the industry. Essentially, they want RBI to consider allowing NBFCs to set off the DLG amount against provision, arguing that even Ind AS accounting standards allow for setting off this DLG against provisions provided the NBFCs have clear access to cash flow through an escrow account maintained with a bank. But if the RBI directions are implemented as such, it will imply a higher capital consumption for these lenders, which will eventually hamper ROEs and could lead to lower volumes when it comes to fintech lending. Now, we understand that even as the dialogue with RBI is ongoing, some NBFCs have started to make provisions from the March quarter onwards. Paytm, for instance, started DLG in the last financial year, and as per Macquarie, about 80% of their merchant loans are under this DLG arrangement, so there could be a decline in distribution revenues for the likes of Paytm.
Ritu, thanks a lot for that.